What's up, everyone? It's Scotty with MoneyVest. So welcome on board for another Market Open live stream. We do have the FOMC, not the FOMC, but the Federal Reserve Chairman Jerome Powell's speech in front of the Financial Services Committee. This is a semi-annual hearing that happens once every 6 months, and Jerome Powell is going to be addressing a lot of issues, a lot of monetary policy topics. So this is a very, very important hearing because it's obviously going to be impacting markets' expectations for interest rates, unemployment, inflation, and economic growth. If you guys can see me and hear me, just give me a thumbs up. I just want to make sure the audio and the video is working well here, and we are going to be ready to break this down at around 10 a.m. Eastern. So in just under 20 minutes is when this actually begins. So this is again going to be the hearing that takes place at the Financial Services Committee in Washington, and this is, again, the semi-annual monetary policy report that comes out at around 10 a.m. Eastern. So in just under 20 minutes, we're going to play this. Honorable Chairman Jerome Powell, Chairman of the Board of Governors of the Federal Reserve System as well. So again, let me know in the comments if everything is working well. And once again, thank you so much for joining. And also, do participate in our poll. Do a couple things. Drop a like on this live stream because it really helps us out, kind of push this live stream to more people so everyone can join. And also do share this live stream with other friends, family, WhatsApp groups, Facebook, whatever, so that more people can join us and listen to what Jerome Powell has to say for the economic growth, inflation, interest rates, and all the other really interesting stuff when it comes to monetary policy. So, how is everybody doing? It's been a long time since I've done one of these live streams. I was under the weather for the last week here because I came back from India. I took the flight from West Bengal. It was supposed to be a 5-hour flight, but ended up being over 6 hours long because we arrived late by over 40 minutes. And as a result, I had to deal with a lot of motion sickness and nausea, and just was dealing with a lot of things, vomiting, and just it was a bad time for me over the last couple days here. So I was on some medication and now starting to finally feel better, and hopefully we'll be back on track by the end of this week here and back to schedule by next week. But today and tomorrow, both days, is Jerome Powell's speech here. So again, if you come take a look at the calendar, we've got a semi-annual monetary policy report to Congress before the U.S. House of Financial Services Committee. That's today at 10 a.m. Eastern. And then we have tomorrow before the U.S. Senate Committee on Banking, Housing, and Urban Affairs. And that's also the semi-annual monetary policy report to Congress at 10 a.m. Eastern. So again, these events actually do last a couple hours. So this is going to most likely go on for 2.5 hours because everyone gets a couple minutes to address Jerome Powell, get their questions out, and then for Jerome Powell to kind of address their questions. And then the beige book also comes out at 2 p.m. Eastern today as well. So today and tomorrow we've got packed couple hours each day from Jerome Powell, and that again is going to be very, very, very important for the markets. So once again, do drop a like on this live stream. I would really appreciate that. Subscribe to the channel if you haven't already. Share this live stream with other friends, family members who want to join and listen to what Jerome Powell has to say. And also do participate in our poll and what you expect from Jerome Powell in terms of his tone, whether he's going to be hawkish or dovish, and how the markets are going to react. So again, do all that good stuff so that we can help grow our community as well. So it's been a long time. So again, it's good to see all of you once again. Jeffrey, Lee, Natasha, Deanne, Timothy. Does NVIDIA only go up? It does look like it, right? So Vault, thank you so much for joining, everyone. Really appreciate it. GK, again, do type where you're joining us from in the comments. I would really appreciate that. Let us know where in the world are you tuning in from. We're gonna do one of these again when we have more and more people joined in. But right now we're gonna do it. And of course, it's been a long time since I've done one of these live streams, so it kind of feels nice to connect with all of you once again. So NVIDIA we'll take a look at here in just a minute. So give me 1 second, and if we go back over here, let's take a look. So yeah, semiconductor stocks just continue to move higher here without any regards to the price action, the valuation, or the fundamentals. So Vault here, what do you think? So what's the question again? Let me just take a quick look. So what do you think about crowd earnings, CEO taking shots at other cybersecurity players during earnings call and after hours price action? So I'll be doing a video on cybersecurity. I've actually got one video coming out on a different cybersecurity company later today. and I will be doing a video on all cybersecurity companies similar to what I did for semi stocks and chip stocks, but I will be taking a look at CrowdStrike and of course their earnings, and then we'll also talk a little bit more in detail for all cybersecurity companies, for all chip stocks and semi stocks, in a little bit more detail here in another video. But yes, I will definitely be taking a look at this. Profitable earnings. So finally, the company is reporting some good earnings. 95 cents per share reported earnings with just over $840 million of revenue, jumping over 18%. CrowdStrike has done an incredible job kind of rallying back up to almost new all-time highs here, pretty much all-time highs today, up over 18%, $353, and the market cap now approaching almost $90 billion. This is nothing. This has been just an incredible run up from January of 2023. It's up over 274%. So huge congrats to everybody who's been trading CrowdStrike or semi stocks or cybersecurity stocks in general. But a huge push higher for a lot of these companies. Palantir on the day also pushing up to new 52-week highs, up almost 10% here, with the resistance sitting all the way up to $29, and it's almost running back up to all-time highs also, with a massive move to the upside for this company once again. So huge momentum coming in for a lot of these companies. Mara basically flat, Upstart pushing up over 2%, but we do have, of course, the entire market still struggling a little bit. S&P, although still up about 0.5% after yesterday's sell-off, and we do have, of course, NASDAQ pushing up over 77 basis points back over 16,000, and the Dow Jones here up over 100 points on the day, with Tesla here down a little bit over 2%, so still struggling. Nvidia up over 2.8, almost at $900 per share. Nvidia is just absolutely incredible momentum for the stock, hitting new all-time highs, and of course AMD up over 4% to new all-time highs here, and SMH, which is a semiconductor ETF, up another 2.5% to almost new all-time highs once again. So this has just been incredible momentum for both of these stocks, and of course, not to mention for most of semiconductor stocks here, and SMH sector in general. So semi watch list, everything is green. SMCI up to $1,100, TSMC up over 4.7, AMD, Nvidia, Qualcomm, SMH, Texas Instruments, Applied Materials, ASML, everything pushing higher very, very nicely. We'll take a look at Bitcoin here in just a minute, but let's see. So people joining in from Singapore. We've got Spain in the house, India, Atlanta, Georgia. We got New Jersey, Boston. Shout out to all of you guys. So thank you so much for joining in from all over the world. Really appreciate that. Do you also watch Indian indices? So yes, I do invest in Indian stocks, but of course, I don't kind of track that on a daily basis. But yes, we do. I personally do invest in Indian stocks as well. Hoping Powell to say short Nvidia. I don't think anybody in their right mind is even touching Nvidia on the short side. Just the trend is very much in favor of the bulls here. There's so much optimism. There's so much euphoria around chip stocks that it does start to feel like, times that we've already seen. There's been a lot of greed in the past as well. And similar to what we have already seen, it kind of feels like that once again. Rich says, feels like 2020 again with the live streams. So yeah, I mean, we used to do that up until 2023. Like, it's just been the last, I would say, 4 to 6 months that we haven't really done that, because I've been traveling a little bit, and just focusing on some other projects, because we have our own website coming up. So I haven't really been able to dedicate as much time on the live streams. But once we have our own website built and ready, and ready for access with features and everything for all the members, then we're going to restart all the live streams once again, because I'll have a lot more time on my hands. Right now, just been working with developers, just been working with designers to kind of see what it's going to look like with the API providers. Data is expensive. Let me tell you that. Data fees is not that cheap, because a lot of these companies, Bloomberg and Chicago Board Exchange, Options Exchange, a lot of these indices data, CBOE, a lot of these companies charge an insane amount of fees when it comes to data. But anyway, so we demand at least one live stream per week for whole community, or at least one for Patreon people. So I'm actually going to be doing one every day. Once again, live stream's going to be back on track here as soon as the website is up and running. Just like I said, I've been super occupied with working with all the design and the developers here. But once it's all and ready and good to go, then we're going to restart our live streams once again for all the members, for everyone, for the community. So super excited, and it's going to be a product for all of you. So this is going to be something that you tell me what type of features, what type of functionality, what type of use case, what type of data you want to see, and we'll put it up there for everyone to use on the moneyvest.com website. So really, it's at the end of the day, I want this to be the best financial analysis and macro analysis platform for everyone. So we're working diligently to make it happen. And at the end of the day, it's really going to come down to you, and your feedback is going to be very, very helpful for all of us so that we can make this the best offering possible. How are you doing, Srinivas? First of all, congratulations to you, Caddy, for your recent promotion as Chachas. Thanks so much. I really appreciate that. Missing him already. It was such an amazing time the last couple of weeks. Got to spend in West Bengal with my brother, with my sister-in-law, and of course my new nephew, and it's just been an amazing time. So Caddy, the MoneyVest website is going to be integrated with Patreon for logins, or we'll be creating new accounts. So we'll be creating new accounts. The billing is going to be handled with Patreon, but the website is going to handle all the accounts and everything. You can manage your memberships over there as well. But we're super excited with a lot of financial calculators and models that are going to be available to calculate intrinsic values for all the companies, all the US stocks, at least for now, and then including our MoneyVest metrics, which is going to be over 70 plus metrics that we look at for each company. That's going to populate, and it's going to make really the analysis part so easy, because once you populate the stock, it's going to show you all of our MoneyVest metrics in one single table. And it's going to tell you, like, in terms of growth and, financial health of the company, the valuation, the efficiency, the management, and, of course, the margins, all that profitability. Everything is going to be laid out very nicely for all of us to see. Anyway, so everyone, do me a favor, drop a like on this live stream. I would really appreciate that. It pushes this content out to more and more people. Do subscribe and also share this video, share this live stream with your friends and family on WhatsApp or Facebook or whatever you use. And also do participate in the poll. Right now, we're only sub 90 votes. We're trying to get to at least 200 votes here before Jerome Powell starts talking here at 10 a.m. Eastern. So it's going to be in under 8 minutes now. Is when Jerome Powell is going to start talking at the Committee of Financial Services. He's going to give his testimony. So that is going to be very, very important for the markets. I'm going to do an audio check fairly soon here so that everyone is able to listen to what Jerome Powell has to say. And then, of course, we'll take a look at the market's reaction accordingly. But right now, the markets are very much green on the back of semi-stocks and chip stocks that continue to push higher here with NVIDIA, AMD rocketing to new all-time highs. We will still have our Discord, yes. So Discord group is going to continue as normal. It's going to function. It's going to be still our place to engage as we usually do. But the website is going to be mostly for personal finance dashboard, like tracking your portfolio. And then, of course, doing your full fundamental analysis on individual stocks. So calculating fair values using different valuation models, including our MoneyVest metrics, and looking at insider trades, looking at earnings estimates, looking at analyst estimates, looking at the macro dashboard is going to include volatility and S&P 500 and overall bird's eye view of the market temperature. Then, of course, we're going to have some technical indicators. So there's a lot of incredibly good ideas that we are going to be putting on the website that it's going to super help you in kind of doing the full analysis on individual stocks and, of course, the markets in general. Okay, do we see an uptick in bond yields soon? Well, the yields continue to drop back down here. 4.1% is where we are. We've done a couple analysis on the bond yields. We did see, a little bit of that momentum back up for yields. So you'll notice that we did push higher from 3.7 back up to over, a little bit over 4.3%. So pushing up over 14% for the yields. And right now we're starting to come back down for the 10-year treasuries. So, we already know that the U.S. is going to once again issue a lot of bonds here in the coming weeks and months and quarters, because there's still going to be a deficit this year also based on the CBO's expectations of outlays and tax receipts. So that is still going to increase some supply. But if the demand continues to be strong, then there's possibility for for prices to go higher, yields to come back down, because there's an inverse correlation between prices and yields. But right now, of course, 3 back-to-back weeks of pullbacks in the 10-year treasuries, and it's starting to get rejected here at around this 4.3, 4.4% ceiling, where previously we kind of got rejected back in October of 22. So I'd be watching closer to 3.8.5% level once again for the 10-year treasuries. And of course, if we kind of bounce back higher from those levels, or if you break out above that level, it's going to depend very much on the issuance of the government bonds, with respect to inflation and interest rates, and of course monetary policy as well. But the TMF trade is possible that it could be back on. This week it's up a little bit over 3%, so it's possible that we do see some potential upside once again with a resistance sitting all the way up to $65, $66. That's exactly where we got rejected more recently. That was a previous support, which now is acting as a resistance. So if you do see some more potential upside here, north of 15%, then it's going to come up to that resistance. Then we're going to have to wait and see whether we get a breakout or a rejection once again for TMF. Okay, so we're going to cover a lot of the stocks here towards the back half of the live stream because, again, we're just waiting on the hearing to begin in under 5 minutes. This is going to start, and I'm going to do an audio check. So we're going to place this over here on a separate tab, and then we're going to put down, of course, the market behind that so we can take a look at the market's reaction to everything that Jerome Powell is saying as well. And like I said, I'll be doing an audio check, so let me know if you all can hear it and, of course, see it, and there are no issues in terms of the technicality of things. So boom, we should be all good to go here, and then we'll just put this like this. Perfect. So again, we're gonna keep a close eye on individual stocks as well. Apple here obviously been selling off, now sub 170. Amazon's been pulling back from its highs of 179, $180. So obviously down intraday. And Tesla here really struggling. So Tesla struggling a lot. My covered calls expire on March 28th at 225 strikes, which are now up close to over 95%, I believe. So they're still up 88%. That's interesting. They were up 88% yesterday, and they're still only up 88% today. But my end-phase calls are up 77% also. So again, if you were interested in trading options, and that's one of the things that I've tried to kind of convey my message to as many investors and people as possible, that that options trading doesn't have to be risky all the time. If you understand how to sell options the correct way, you can actually generate some decent income, some cash flows, some profits here on a regular basis. Our success rate, I would say, for selling options is really, really high in our community, collectively speaking. And most options that I've sold, there's been profit because these are mostly for me net neutral positions. If the stock goes up, great. If the stock goes down, that's also fine because we're able to generate that passive income through selling options through premiums. Buying options, is very rarely successful, at least not on a consistent basis. Yes, you can make money, few trades here and there, but if you are looking to do this long term on a consistent basis, selling options is the way to go, in my opinion, and that's what I've experienced over the last several years of trading options and just trading stocks in general. That selling options is far better strategy if you know what you're doing. So you can right click on the video and go picture-in-picture mode. Really? Let me just try that. On the video. Doesn't maybe you're talking about this? Yeah, I don't know how to do that, but this is how we've always done it with, of course, the markets in the background, with the videos playing over here. So 2 minutes left. 2 more minutes, actually under 2 minutes for the Federal Reserve Chairman Jerome Powell to come on board and start talking. Folks, please do me a favor. Like this video, like this live stream. Subscribe to the channel if you haven't already. Share this live stream with folks that you think might be interested in joining us and listening to Jerome Powell, because this is going to be a longer live stream for the next 2 hours. We're going to be listening to what Jay Powell has to say. And also, do participate in the poll. We've got 143 votes right now. We're trying to get to over 200. And what do you think? What do you believe? Is Powell going to be hawkish or dovish on his speech, on his testimony today? Let us know in the live chat. Let us know in the poll here. So do participate, and definitely it's going to help us gather some more data and make better decisions. So JT says, but need a lot of capital for options for beginners. It's risky. So in general, trading and investing is risky. Right? What doesn't carry risk? Everything carries risk. Every strategy, if you are putting your money to work, if you are investing, everything carries risk. There's nothing out there that doesn't carry risk. But from a probability standpoint, from a successful strategy standpoint, in my opinion, selling options is far better than buying options. It's a lot, in my opinion, less risky, especially if you're doing covered calls and cash secured puts. Yes, it does require capital, so that's the higher barrier to entry for most beginner investors. But in my opinion, that's also kind of one of the best strategies out there, in my opinion, in my experience. So anyway, we're going to move over to this. We've got, again, the NASDAQ over here, the 1 minute chart. We've got the S&P 500 down below. On the 1 minute chart, both of them are currently up. Intraday, they are selling off a little bit. I'm going to do an audio check. So we are getting started now. I'm going to do an audio check. So please do let me know in the live chat if you guys can hear it and see it. Just give me a thumbs up and we should be all set and good to go for the 2 hours that we're going to spend here listening to Jay Powell's testimony in front of the Committee of Financial Services. So hope you all are ready, and also do like and share this live stream. I would really, really appreciate that. So I'm going to do an audio check here. Just give me a thumbs up if everything's working well. So right now, I think they're just taking their sweet time to get this live stream started, but should start fairly soon here in a couple minutes. So in terms of audio, we're still waiting for this to get started. That's all it is. As soon as they begin, you should be able to hear it. There we go. Just give me a thumbs up, okay, if everything's working well.
Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing is titled The Federal Reserve's Semi-Annual Monetary Policy Report. An inventive title we use semi-annually here on the committee. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I will note at the outset that this hearing has a hard stop at 1 p.m., which will be strictly observed. I see Chairman Powell smile. It's just 3 hours. I'll now recognize myself for 4 minutes to give an opening statement, and welcome back, Chair Powell. Since you last appeared before the committee in June of 2023, the conversation in Washington surrounding inflation has shifted significantly. To be clear, it's not because the inflationary fire has been extinguished. From the most recent data available, food costs are up 21% since President Biden took office. Energy costs are up nearly 32%. Shelter costs are up more than 19%. And you'll pay 37% more for a dozen eggs in America today. As you stated in January, people are still paying more for the basics of life, and the prices they're paying are still high. Families aren't happy about it, as you know, and as our colleagues know. But according to the Biden administration, many of my Democrat colleagues, they should be thrilled. In an attempt to score political points, many in Washington have decided the best strategy is to tell people what they're feeling isn't actually accurate. They claim Bidenomics has brought down costs, and their partisan so-called American Rescue Plan put our economy back on the right track. Of course, we know the opposite is true, since inflation skyrocketed soon after the American Rescue Plan was enacted, which was predicted by several former Obama administration economic officials. Instead of working to solve the underlying issues causing high prices, the administration has played the blame game, citing corporate greed and so-called shrinkflation. Some Democrats have even trained fire on you, Chair Powell, blaming interest rate hikes, which were necessitated by Democrat spending, for the high cost, and brazenly calling you to make cuts prematurely. It's highly inappropriate for lawmakers to attempt to influence monetary policy. Chairman Powell, I have faith that you will not allow politics to cloud your judgment in the fight to tackle inflation. As I have always said, you're a steady hand, and I believe you are committed to the Federal Reserve's independence, as am I. Just as you have rejected the outside pressures of politically motivated agendas, I hope you will be just as attuned to the threats of politicization when the calling is coming from inside the House. Vice Chairman Michael Barr's so-called holistic review of capital requirements and the fatally flawed Basel III endgame proposal represent a concerning trend of partisan proposals taking priority over supervision. This has real-world impacts, as we saw 1 year ago this month when the supervision and regulation arm of the Fed was late catching up to the effects of the acceleration of interest rates on the banking system. Americans were understandably shaken by last year's banking turbulence. As we continue to monitor potential instability, including bank exposure to commercial real estate, it's critical that the Fed keep its eye on the ball. This does not include enacting new, far-reaching, and ultimately harmful regulatory policy, though. As you know, members on both sides of the aisle, on this committee and in Congress, have made clear that the Basel III endgame proposal would be catastrophic for families, communities, and small businesses. Regulators should withdraw it and start over. I think that's the proper course with something as deeply flawed as the current proposal. Additionally, given that other significant proposals would have to fit holistically together, regulators cannot simply proceed with them as separate modules or using a cut and paste approach. Most importantly, as the Basel III endgame proposal is discarded or altered, I strongly urge you and other regulators not to finalize the long-term debt proposal. Instead, Chairman Powell, I would encourage you to stick to the task at hand and follow the data. The stakes are way too high to put politics over sound policy. With that, I yield back, and I'll now recognize the ranking member of the full committee.
Thank you very much, Mr. Chairman. Good morning, everyone. Welcome back, Chair Powell. While I am pleased by the progress the Fed and the Biden administration have made to tackle inflation, we're not out of the woods yet. In fact, even though my Republican colleagues refuse to acknowledge this fact, housing, is still the #1 driver of inflation. Based on the latest data, housing costs continue to make up nearly 70% of overall price increases, outpacing modest wage gains. This means that until we address the underlying housing supply shortage, Americans will continue to pay an increasing share of their income on housing. The affordability crisis will worsen and inflation will remain too high. With that said, it's hard to understand why Republicans feign concern about the economy when they're unwilling to address the key driver of inflation, housing. In fact, Republicans have only put forward legislation that makes things worse for millions of Americans, including moving legislation to slash funding for federal housing programs, including in rural America, where homelessness is rising. This abysmal record on housing is par for the course for Republicans. Since they have been in the majority, they have convened only 6 hearings on housing, on top of launching baseless impeachment efforts, censoring members, and pushing our government to the brink of multiple government shutdowns. It's clear that Republicans are too focused on drama and chaos to deliver anything for the American people. That's not how Democrats roll. When I was chair of the committee during the 116th and 117th Congress, not only did we hold 55 hearings on housing, but I and my fellow Democrats enacted 12 critical housing bills into law in the last Congress alone that helped stymie a tsunami of evictions, foreclosures, and homelessness, keeping millions of people stably housed during and after the pandemic. Unlike Republicans, we don't just talk about the issue, Democrats make law. As House Republicans continue to disappoint, committee Democrats are offering evidence-based solutions to keep a fair and affordable housing agenda at the top priority in Congress. That's why I and my Democratic colleagues reintroduce 3 groundbreaking bills to address the housing crisis and bring down inflation once and for all. This includes Housing Crisis Response Act, the Ending Homelessness Act, and the Down Payment Toward Equity Act. Together, these bills would create nearly 1.4 million affordable, accessible, and resilient homes, reduce housing costs in homelessness, and revive the American dream of home ownership for all. So, when my Republican colleagues are ready to get serious about our nation's economy and inflation, Democrats are ready to work with you to pass the bills into law. In fact, tomorrow at noon, I, committee Democrats, and more than 30 housing advocates will join together at a press conference to share just how important ending the affordable housing crisis is to the state of our union. And so I invite all of my Republican colleagues who say they care about this issue to come on and join us. I look forward to discussing this critical issue with Chair Powell today. And Mr. Chairman, I yield back my time.
The chair recognizes Mr. Barr, Chairman of the Subcommittee on Financial Institutions and Monetary Policy, for 1 minute.
Welcome, Chairman Powell. Runaway inflation and increased interest rates still have Americans reeling. And while the rate of price increases have come down thanks to monetary tightening, the overall level of prices remain high. The toothpaste is out of the tube, and Americans, the average American family, still is paying about $15,000 more for the same goods and services that they were purchasing just 3 years ago before the Biden administration. So Americans have suffered years of eroding purchasing power in their paychecks. And while I'm pleased the Fed is resolved in getting inflation back under control, I'm not pleased by the numerous recent unjustified, politicized, and underanalyzed regulatory proposals. The Fed needs to withdraw and repropose the irredeemably flawed Basel III Endgame proposal, especially given that 97% of public comments across the ideological spectrum express disapproval of the proposal. Chair Powell, I urge you to listen to the American people, withdraw the Basel III Endgame proposal, and tell us today what the Fed's plans are moving forward. I yield.
The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair Powell, for being here today. And I had a chance to actually read the monetary policy report from cover to cover thanks to an exceptionally long airport delay, going back home last weekend. And the feeling I got again and again is that things are fairly well recovered from COVID and getting back to normal, that we're in the range where ordinary monetary policy and fiscal policy will allow us to satisfy your dual mandate. Today, unemployment remains near historic lows. Core PCE inflation is down to 2.8% year over year compared to a peak of 5.6% in 2022. And the major stock indices are hovering around record highs. GDP growth continues to beat expectations, and the U.S. economy has added more than 14 million jobs since President Biden took office. The GDP itself is pretty much back on the trajectory that it would have been pre-COVID. U.S. manufacturers alone have added nearly 800,000 jobs, employing more workers now than any point since 2008. And so my lesson from that is that the fiscal response that we engaged in was appropriately tailored, and the soft landing is within sight. Thank you, I yield back.
Gentleman yields back. Today, we welcome the testimony of Jerome Powell, Chair of the Federal Reserve's Board of Governors. As you know, you'll be recognized for 5 minutes for a summary of an oral presentation of your testimony. Without objection, your written testimony will be made a part of the record. Chair Powell, we're now recognized for 5 minutes.
Chairman McHenry, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As the labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped to narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Long-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We've also continued to shrink our balance sheet at a brisk pace and in a predictable manner. A restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman Powell. I should have noted this at the outset, but this is your 25th testimony before the U.S. Congress as Chair of the Federal Reserve, and we thank you for your service and your commitment to congressional oversight. Very much appreciated. I'll now recognize myself for 5 minutes for the purposes of questions. Let's begin with what's top of mind. We have two issues that are top of mind with the Fed: regulatory policy, with the Barr proposal, the Michael Barr proposal on capital, and interest rates. We're in a political year, and the lens of a political year falls heavily on all government, all parts of government. There's a lot of debate about the past 3 years of high inflation and the impact on American families. And now that inflation is receding, there's been a great deal of speculation about when the Fed would cut rates. Some say that it's going to be a lot of rate cutting this year. Some say none. What say you?
I say that really it will depend on the path of the economy. Our focus is on maximum employment and price stability, and the incoming data as they affect the outlook, and those are the things we'll be looking at. I can go further if you'd like.
So at what point will the Fed be forced to cut rates? What does the data, what kind of data would you point to? And do you have any updates there?
What we said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%. We have some confidence of that. Inflation, headline inflation has moved down more than 3 full percentage points now to 2.4%, as I mentioned in my remarks. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. It's a very important step. We think because of the strength in the economy and the strength in the labor market and the progress we've made, we can approach that step carefully and thoughtfully and with greater confidence. And when we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy.
Well, let's pivot to regulatory policy. Chair Powell, as you know, there have been serious concerns expressed on both sides of the aisle and across America and across industries about the Basel III endgame proposal that Vice Chair Michael Barr has proposed and that the Fed is taking up. The concern is on both process, meaning how the proposed rule was developed, analyzed, and released for comment, the general concern of a lack of economic justification for these actions, but also on the substance. The proposal goes much further than the Basel III committee recommended on capital requirements, putting us at a great disadvantage internationally, potentially. So my first question is on substance. Is the Fed listening to these comments that have been nearly unanimous in opposition to this rule? Is the Fed listening to these comments on the impact the rule will have on everyday Americans? And what is the status on rulemaking, and what is the plan moving forward?
So you're right, we've received voluminous and very substantive comments, as well as the quantitative impact study that we put out. We got those responses in mid-January, and we're carefully analyzing them. We had asked for very specific, detailed, data-based comments, and I'm happy to say that we did get that. So we're just now reaching the stage where we can begin to make decisions about how to proceed. We really haven't made any decisions yet, but I think I can say a few things. First, we do hear the concerns, and I do expect that there will be broad and material changes to the proposal. I'll add that I'm confident that the final product will be one that does have broad support both at the Fed and in the broader world. As far as process is concerned, we're really not at the stage of making decisions about that. That's down the road at least a bit. I will say the question we get is reproposal, and I will say that we haven't made that decision, but if when we get to that point that turns out to be the appropriate thing, we won't hesitate to do it.
You won't rule that out? You would not rule that out at this stage of the game, reproposal?
Not at all. No, I think it's a very plausible option. It will depend on how things lie at the time when we reach that point.
Okay. And there's a lot of concern about the interplay between different parts of the rule. And if you change one, what does the economic analysis look like for the new proposal? So it is good to hear that you'll be methodical and the Fed will do its traditional role of building consensus around the substantive changes. And that is your intention.
That is right. I said this would be a thoughtful, deliberative process. It's more important that we get this right than that we do it fast. We understand that. This is an important rulemaking, and it's going to have potential implications for the economy and the people we serve. We're going to take our time and do it right.
Thank you, Chairman Powell. The ranking member, Ms. Waters, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Chair Powell, I want to talk to you about housing, but before I get there, let me address the issue of mergers. Last week, I led a letter along with 15 committee Democrats to you as well as DOJ, OCC, and FDIC, expressing my strong concern about the lack of progress you have made in updating your bank merger review procedures. This is critical now that we just learned of another mega merger involving Capital One and Discover, which would create the 6th largest U.S. commercial bank with a major role in the credit card market. For far too long, experts have raised alarm that there is a rubber stamping process of bank mergers where virtually all applications are approved. All the while, unbridled market consolidation poses great risk to consumers and entrepreneurs. What is the status of your updates to the merger review process? And does the Fed plan to convene public hearings on the Capital One and Discover merger?
So I believe we're in regular contact with the Justice Department on what's going on with their review of merger practices. We're looking at that and considering. I think on the potential merger with that you mentioned, we haven't received an application, so there's really not much to say yet. It's early days. When we do get that application, though, we're going to evaluate that merger as always under the factors laid out under the law, and that's our commitment.
So you do believe that your bank merger procedures are ready to do the work that's necessary when you evaluate this possible merger?
I do.
And are you supportive of organizing community hearings on this merger?
I haven't talked about that with anybody. I will say this: we've done that in many large mergers, but that's not a conversation we've had yet. We literally don't even have an application for the merger yet.
Thank you. We'll stay in touch with you on that. So turning to the national affordable housing and homelessness crisis, where we've seen steady increases year after year in home prices and rent costs, which are a symptom of the chronic undersupply of affordable housing. Indeed, more renters and homeowners are now spending more of their income than ever on housing costs. And as you know, housing costs continue to be a primary driver of inflation. Do you think the Fed has sufficiently emphasized the role that housing costs play in keeping us from your 2% inflation goal? Do you think it's reasonable to believe that monetary policy can accomplish this goal without a fiscal policy response? And if you do, how long will it take to get there?
Housing services inflation is one of the three components that we look at that make up the core PCE and, index. And it has been coming down from its heights of a couple of years back. It's part of the story. I think the overall story is that goods price inflation has turned negative. Goods prices are actually coming down a bit. Housing services inflation, you can see from more, currently entered into leases that as leases turn over, the increases are going to be smaller. So in our forecast and in everyone's forecast, housing services inflation comes down.
It's been reported that the methodology used to assess housing costs as an indicator of inflation is imperfect. Namely, because it considers costs based on both new and old rent, including for owner-occupied housing on a month-to-month basis. This results in stale data since families' housing costs typically do not change unless they move or their lease is up for renewal. So to address these imperfections in the housing cost indicators, the Bureau of Labor Statistics and Cleveland Fed created an improved methodology based solely on new lease rents, which is referred to as new tenant repeat rent index. Has the Fed incorporated this new indicator into its economic assessments? If not, why not? And so what changes has it had on the level of housing inflation observed by the Fed?
So we're well aware of that, and we do incorporate it into our thinking. As I was starting to mention, that is the reason, the fact that market rents are moving up at a much slower pace is the reason why forecasts are for housing services inflation to come down, and that absolutely plays a role in our thinking.
Thank you, and I yield back.
Gentlelady yields back. The Vice Chair, Mr. Barr, I'm sorry.
Wrong Vice Chair.
Wrong Vice Chair. The gentleman from Arkansas, the Vice Chair of the full committee, Mr. Hill is recognized for 5 minutes.
Thank you, Chairman. I want to welcome you, Chairman Powell, to the committee. We're glad to have you back and your expertise. And I want to pick up where Chairman McHenry left off on his conversation about Basel III Endgame. You made a good point saying you're not taking the whole concept of reproposal off the table as you review the analytics. And you all discussed the interactivity of that rule with other rules. So if you were to repropose the Basel III Endgame, would the Federal Reserve delay then the long-term debt proposal that's on the table? In other words, would you agree that the agency should not finalize this long-term debt proposal for bank holding companies until banks have a better understanding of what their capital obligations under Basel III Endgame might be?
So we haven't made the first decision yet, so it's hard, I couldn't say definitively, but yeah, that's a question we'd be asking ourselves is what would be the implication for other rules, including the long-term debt?
Well, and is the Fed considering changes to the requirement for regional banks to issue long-term debt? Right now, it's stated to be issued at 6% of risk-weighted assets in abundance of caution in case there needs to be a resolution, obviously. We know the logic for it. But as I understand it, it's being required at both the holding company level and down at the bank level, and that seems redundant to me. Are you aware of that, and have you considered changing that in your discussions?
Yeah, so that's another area where the comment period ended a little while back, and so once again, we're in the process of evaluating the comments. There will be a thoughtful, deliberative process around that. We welcome comments on these kinds of things. They're very important implications for the banks that are affected. We want to understand the effects, make sure we understand them correctly so that we can evaluate, what a final rule should look like.
Good. Let me turn to the monetary policy outlook. As the chairman noted, consumer prices are 17% higher for American households since President Biden was inaugurated back in January of 21. And yet, in spite of that 17% increase in cost, real wages have actually fallen 2% over that period. So there's no doubt that inflation is the biggest issue facing American households. And in my view, there's three principal causes. Certainly we had supply disruptions, but we've had unprecedented fiscal policy laxity. You described it in a recent interview as unsustainable. But we also think that the Federal Reserve, in my view, and many people on this committee commented, should have reduced accommodation after the pandemic sooner. One of the things coincident with that, which is what I want to talk to you about, is that the FOMC announced in August of 2020 this flexible average inflation targeting framework right in the middle of the pandemic, which many of us didn't understand why the Fed would take that decision then, but it would give you flexibility on the 2%, saying the Fed could allow inflation to rise above 2% and stay there above that level for some time because the Fed had had such challenges in getting the price level to 2%. That was a major shift in the Fed's approach. Do you think, in retrospect of now what we've witnessed over the past 4 years, that that was a mistake in hindsight to change that framework, and is it under review?
So we said we would do a review on a 5-year basis, and that means we'll be starting that review toward the end of this year. So we really haven't started. I do think that the question you raised will be one of the questions we look at, but the bigger question really is that change in the approach was really based on the fact that we'd had very low interest rates and very low inflation for a long period of time, and policy was always very close to the effective lower bound, so there wasn't any firepower for central banks, and so it was a way to keep inflation expectations anchored at 2% and not have them slide down. Now we have entered a different period. The pandemic really may have changed that in a sustained way. We don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now? And if it were, that would have ramifications for our framework. But we haven't begun the review yet. It'll begin at the end of this year and probably end late the next year.
Thank you. Yield back, Mr. Chairman.
Gentleman yields back. We'll now go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I think I want to pick up a little bit right where we are. 2019, 2020, the entire world was under the unprecedented pandemic with COVID rate. Is that correct?
Yes.
At the time. And that changed a lot of things with reference because not just for the United States, but for the entire world. And it affected the economies of countries just about on the planet. That's not also correct?
Yes.
And supply chains were disrupted. In fact, I can remember many Americans and people around the world could not get toilet paper or paper towels and some of the basics. And so the prices, because of the of supply and demand, skyrocketed, causing the inflation, not only in the United States, but basically all over the world. Is that correct?
Yes.
And so therefore, the Fed had to do certain things because of what we were in at that particular time. We couldn't just go back and act like the pandemic wasn't there. We had to do something to try to make sure that we were able to get through the pandemic. Is that not correct?
Yes.
And now we're at that point where we're about to get through this pandemic. And we can look at the rest of the world, what they did or didn't do at that time, but what we did at that time. And as a result of that, 3 years post the pandemic, when you look around the world, I think that you were correct with what you stated, that by most accounts, our economy is doing well. In fact, I would say our economy is doing better than most of the other countries in the world. Would you say that's correct?
I would.
And so, I would say then that some of the other countries of the world maybe should have looked at the policies that we put in place thereafter so that they could get out of it, so that they could have a labor market that is strong, where the unemployment rate is near a 50-year low. And as you've stated, inflation is also now coming down faster than any place else on the planet, just about. Is that not correct?
I think that's right, yeah.
And I think that you also recognize a mismatch between the strength of the economy. That's what we're talking about in the field. And I think that Ranking Member Waters touched on one of those big issues of housing, of which is now, we're still trying to get that under control. And I think the Ranking Member has some ideas on how we can do that, and that may be something that you need to consider so that we can further get down the inflation rate. And the other would be the commodity markets, because the cost of food is too high and people. So that's something else that we need to get in control. Is that not correct?
Yes.
And let me just ask this. Can you say that there's a connection, for example, between conflicts in other areas of the world, like Russia's war against Ukraine and or the turmoil in the Middle East and the economic pressures that the United States feels? Does that not also go into the reason why the cost of commodities can be still higher? Is there a connection therein, Mr. Chairman?
Certainly, the war in Ukraine caused commodity prices to move up sharply.
So, could you tell you what is the what would the connection lead you to believe that there is an urgent need for us? I would think for when we're running out of time, for us to do everything that is in our power in Congress to support Ukraine, so that we can make sure that and other strategic partners, that we can help the commodities market, and that would help lower the cost of some of the commodities, bringing food prices down, if we would just be able to pass certain things that's going to help Ukraine right here in the United States Congress. Is that correct?
Here's where it gets outside of our jurisdiction. So I wouldn't have an opinion on Ukraine funding.
But if we had more grain that was going through, wasn't blocked by Russia, things of that nature, that generally just says that helps bring the cost down. Cost is higher because of the disruption in the Black Sea that's happened because of this war. So that would help bring the cost down. That is not necessarily the policies just here in the United States, but that's the policy because of what's going on in Russia. And we need to make sure that we do something to prevent that if we really are serious about bringing inflation down. Is that not correct?
It is correct that a full supply of grain would help with commodity prices.
And so, instead of us playing politics with this and acting like it is your fault or anyone else's fault that we had to go and do what we did because of the unprecedented pandemic, what we did was save the economy then, knowing we got some problems that we had now, and now we are recovering quicker and better than any other country on this planet as a result of your policies and the policies of Joe Biden.
The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, thank you for testifying today. When you were before this committee a year ago, I cautioned against raising capital requirements on commodity derivatives that our agricultural and energy producers use back home to keep prices of food and power stable for consumers. At the time, you said that was a very specific concern and you weren't sure the proposal would even address commodity derivatives. And in fairness, that was before the Boswell proposal was officially published. Unfortunately, we now know that the proposal does impact commodity derivatives, and in fact, they are among the most penalized financial products that banks offer. And I would note for just a moment, I very much appreciate your comments and responses to Chairman McHenry about the nature of the overall proposal. Congress wanted end users to be able to secure their hedges without posting margin to keep the derivatives markets affordable. But I've seen estimates that some of these types of transactions for end users could face 10 times the capital requirement. Chairman Powell, make me feel a little better. Ease my concerns here. Will you and the Fed work to fix this?
Let me start by saying I want to echo the fact that our commodity markets and our capital markets are a huge national asset, and we need them to be functioning well and with as little friction as possible. I now understand that what you're referring to is things that were done to increase capital requirements for various kinds of derivative activities. And I'll just say that's an area we're aware of the concerns, and it's an area that we're taking a very close look at.
I appreciate that. I was a member of the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, farmers, ranchers, small businesses. This had broad bipartisan support then and still does today. Unfortunately, the Fed could undermine this longstanding work done by Congress. I'd like to enter a few letters into the record, Mr. Chairman, that discuss the detrimental impact to end users. First, a joint Agricultural Trade Association letter from the American Farm Bureau Federation, the National Cattlemen's Beef Association, among 7 others. Next, a joint Energy Trade Association letter from the American Gas Association and 4 others. And lastly, a letter from the American Public Power Association and the National Rural Electric Cooperative Association.
Without objection.
Thank you, Mr. Chairman. Chairman Powell, I'd now like to focus on how the proposal is set to significantly disincentivize banks from offering clearing services. In Dodd-Frank, Congress mandated central clearing as a way to reduce risk in the system. The number of banks that can clear derivatives for end users has reduced over time, making it harder for end users to find a bank to offer this service. There are some estimates that the Fed's proposal will increase capital for this activity by 80%. I'm worried that this will make it even harder for end users to find a bank to clear their hedges. This also comes at a time when the SEC, our friends at the Securities and Exchange Commission, has just finalized a rule in December that will increase clearing in cost in Treasury markets. This will have a real impact on market access and liquidity, not just in commodities, but the $26 trillion Treasury market that plays a critical role in the world economy. Will you work with the CFTC to address this problem?
Again, I'll say that we're aware of those concerns, and we're prepared to work with other agencies and also to make sure that our capital proposal appropriately addresses them.
The strength of central clearing is entirely dependent on banks' willingness to participate, and problems with the Boswell endgame warrant a full reproposal to give us time to appreciate their consequences. And there are real consequences, as you and I both know, Mr. Chairman. And with that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman, and welcome again, Mr. Powell. It's an honor to have you before us today. I always enjoy hearing your commentary. As you know, recession and inflation, these are buzzwords, and they are used in some circumstances to cast a dim light on perhaps the Fed and others who are working to end some of these troubling circumstances we're dealing with. Are you now at a point where you believe that there will not be a recession? There was much talk about recession, and many people worried that we would find ourselves having to negotiate our way out of a recession. What is your position currently on a recession?
So U.S. growth last year was in excess of 3%. What we're seeing so far this year is continued solid growth. My expectation, and that of other forecasters and of my colleagues, is that we'll see continued growth at a solid pace. I will say, so there's no evidence, or no reason to think that the U.S. economy is in or in some kind of short-term risk of falling into recession. Having said that, though, there's always a possibility, a meaningful possibility that an economy will fall into recession. I don't think that possibility, though, is elevated at the current time.
Thank you. I appreciate you saying this, because we want to, at some point, eliminate the great deal of fear associated with just the term recession. Next point, the December FOMC projections showcase a slightly lower unemployment rate than last June's projections and slightly higher GDP, suggesting a soft landing remains likely. Are you of the opinion that we're headed to a soft landing, Mr. Powell?
I'll just say that what we've seen so far is an economy that's growing at a solid pace. We're seeing a labor market that is still tight, still strong. Wages are moving up, but the labor market's coming into better balance between supply and demand, and inflation has come down sharply, really, since the middle of last year. So those are the conditions we see. They're very attractive conditions, and we're trying to use our policies to keep that growth going and to keep that labor market strong while also achieving further progress on inflation. That's our goal. And I think there's a possibility we can achieve all of that while keeping the labor market strong and the economy growing? Yes, I think there is a possibility. Indeed, that is what we're trying to achieve.
A soft landing can be difficult to identify. We could possibly have a soft landing and miss the point at which the landing took place. How do you define the soft landing such that a member of the public, a layperson, would understand that we have indeed had a soft landing?
So we really think about it in the terms I just discussed, which is we want to keep the economy growing. We want the labor market to remain strong. 3.7% unemployment is pretty near 50-year historical lows. We want inflation to continue to move down closer and closer to that 2% objective. And we've made, quite good progress on that over just the past year. So we want to continue those conditions. And I don't want to put the label on it. Other people can do that. But I would just say we're using our tools to, keep a strong labor market and strong growth while, making further progress on getting inflation down to 2% for the benefit of the public. That's the economy that we're trying to achieve. And I think there's we're on a good path so far to be able to get there.
Well, I concur, but I would ask this as my last question. Will there be some announcement at some point that we've had a soft landing? Because we have people who are continually indicating that we're not having a soft landing, there's a possibility of a recession. So will there ever be some official statement that would give people some comfort?
I don't think by us, no. I think we're just going to keep our heads down and do our jobs and try to deliver what the public is expecting from us. We wouldn't be, declaring victory like that, but.
The gentleman's time has expired.
Thank you, Mr. Chair.
Thank
The
you.
gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Mr. Chairman, thank you very much. Chairman, welcome back. I think we enjoy this. I hope you do too. I know there's some bit of trepidation about all the things that are available to us and you to answer. I learned a long time ago on a campaign trail, every problem can be solved on a campaign. Reality is a little bit different. Welcome back despite all that. Looking at the Monetary Policy Report, March 1st, 2024. And as I review this, I would like to focus on the term that I would say, high prices are here to stay. Because what I've heard you say today in this report really go to is, you got everything under control, but we're going to keep the high prices. And I think the high prices really take a toll on the American people, as you're hearing from our colleagues, no matter whether they be Republican or Democrat. Page 7 of your report, you don't have to go focus on it, says, while current services, core service price inflation has been slowing, but remains elevated. It does. Labor costs, as you know, and energy costs are a driver to your monetary policy. The question that I have is, because you began referencing policy, 2 weeks ago or so, the president announced that he was going to slow down the gifting of opportunities in Texas for natural gas to be able to continue the exploration. And this in Texas is $1 trillion answer problem to us, because if we do not constantly go find through these new finds, but also through the permitting process, we're in trouble. But we're also putting in trouble our contracts that we have with Germany and a lot of other countries. This is going to mean also that business in America continues to have high prices because, as you know, wages are already high and now energy is high, there's no resiliency to continue this and see the American people win. You talked about policy, so what's your advice to policy about energy and what this administration is doing on a policy perspective?
We have, broad, significant, important responsibilities, but we're really not responsible for energy policy, and we try to avoid commenting on.
But it
things that
has
we're
a
not
huge
responsible for.
impact on this report. It arbitrarily keeps prices high. It arbitrarily means that business is not, while they're making money, and while households, people do buy that, it's diminishing their long-term advantages to make progress. So you're just gonna leave that alone?
Really not appropriate for us to comment, on, if I'm commenting on energy policy, I should comment on everything.
Well,
we have a mandate, which is maximum employment and price stability. We take decisions by the legislature and by the administration as a given. We're not in charge of second guessing them. It's just not our job.
Okay, well, all right, let's say we're not going to second guess them. I will. I believe that the energy policies that this president and the Democratic Party have supported are causing a huge boom in prices staying high. They will not come down. A boom in attacking the energy industry, jobs that are associated with it, our foreign policy as it relates to contracts that we have signed with foreign countries, giving up the natural gas market almost entirely on a world market to Qatar. It has a huge impact on whether we are going to keep prices high or control these prices. It has a huge impact on, I think, your monetary report about how many houses get built, how many jobs get filled, whether we have jobs in place, whether we continue to have more jobs available than workers that are there, because over-regulation is having a lot to do with the nervousness, not only on this panel, but also by the American people. It would be my hope that you would pass some sort of a memo and tell them you have no opinion, but you want them to see what the impact is. I want to thank you for being here. Thank you, Mr. Chairman. I yield back my time.
Gentleman yields back. The gentleman from Connecticut, Mr. Himes, is recognized for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell, thanks for being with us today. I have a question, but I want to start by acknowledging, not celebrating, but acknowledging what has been a really remarkable soft landing in our economy. And I'm not celebrating because the American people, consumers, are still feeling the effects of high prices. Wages haven't caught up with prices in some instances. But I think that it would be fair to say that observers would never have predicted the conduct of this economy. You yourself said it in the final press conference of 2023 when you said a very high proportion of forecasters predicted very weak growth or a recession. Not only did that not happen, we actually had a very strong year. So I want to acknowledge that and acknowledge your commitment to independent monetary policy. And because I'm still burdened with this idea that truth and facts matter, I want to point out, especially having listened to my good friend Mr. Sessions talk about the energy market, truth and facts matter. We are producing more oil and natural gas today than any other country on the planet. We are the world's #1 energy producer. I could spend my entire 5 minutes sort of pointing out facts. The fact I want to point out here, and this comes right out of the report, is that the premise that inflation is Joe Biden's fault, is fiscal policy's fault, first is faulty because half the fiscal stimulus that occurred in the face of the pandemic happened under the previous president, Donald Trump, and it has faded. And this report makes the case. Core, and I quote from it, core goods prices have been declining as supply bottlenecks ease and import price inflation falls. So, Mr. Chairman, I don't want you to comment on that because it gets a little bit political, but I do think it's important that we keep some foot on the plane of facts. I do want to ask you a question, though, Mr. Chairman, because I always worry about risks that we see and risks that we don't see. And I want to use the remainder of my time to talk about a risk you're very conscious of, which is the overhang in the commercial real estate market. As you know, the Financial Stability Oversight Council identified commercial real estate as perhaps The most salient risk to the financial system, $6 trillion roughly in loans, half of that on bank balance sheets. In a 60 Minutes interview a few weeks ago, you characterized distress in the commercial real estate market as sizable but manageable. Do you still feel like that risk is manageable? Do you feel like you've got the visibility and the transparency and the tools to address it? It makes me nervous because this has echoes of 2008, 2009, when vacancy rates were declined relatively rapidly. We're not seeing that right now. So how do you feel? Does that risk continue to be manageable, and do you have the tools to manage it?
Yeah, I would say yes to that. I think it is manageable, and we've been, working hard to management for some time now, really. And what it really is it's a lot of downtown real estate where there's too much office supply because of work from home, and also the kind of downtown retail that is no longer as profitable, and things like that are really at the heart of it. So what we've done is we've looked at banks that have significant concentrations, and we've been in touch with them to make sure that they have a plan to deal with that. There will be losses by some banks. It isn't really the big banks, it's really medium and small sized banks that have these higher concentrations. It's going to be with us as a problem we'll be working through, I think, for several years. And the idea is you've got to have enough capital, enough liquidity, and a plan to, take the losses that you're probably going to take. And so that's what we're doing. We're very active in this space with small, medium sized.
So let me ask you about that. Sorry to interrupt, but let me ask you about that. Silicon Valley Bank, wild irresponsibility inside the bank, egregious irresponsibility on the part of corporate treasurers who put so much on deposit. The Fed also had some self-examination to do because the examiners and the supervisors of the bank, quite frankly, were not doing what they should have been. So we might be forgiven for being a bit skeptical of claims of being on this. What has changed in the context of Silicon Valley Bank that gives you the confidence that the supervisors and the examiners will be on top of this?
I see it with my own eyes, but frankly, there's a risk that we would overreact to something as significant as that. It's not like we wouldn't have reacted very, very strongly to what happened with Silicon Valley Bank, and we have. So I know that our supervisors are out there, and we're hearing back from media reports that we have been engaged with medium and small sized banks principally on this. So I am confident that we're doing the right things there, and I do believe it's a manageable problem. If that changes, then I'll say so.
Thank you, Mr. Chairman. Yield back.
The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Powell, for being here today. I'd like to associate my remarks, or myself, with Mr. Hill's remarks earlier with regards to FDIC proposed long-term debt requirements that are based on risk weighting of assets. I think it's an ill thought out proposal, and hopefully your position on FSOC, you'll be able to advise them and hopefully guide them that this is going to be held up until we actually get a Basel III rule. In October 2023, the board issued a proposal to update the debit interchange fee cap and regulation II. This is very concerning, given the data from both the GAO and Fed's own studies show that Reg II has significantly harmed access to free checking and other banking services for the country's poorest citizens. Yesterday, I introduced the Secure Payments Act, which would prohibit a final rulemaking until the Fed, among other things, studies the impact of the board's proposed rule, completes a quantitative impact analysis specifically as it relates to affordable banking services for low-income Americans, and reports those findings to Congress. I understand the Fed acted here because you feel you're facing litigation, but I urge the board to proceed with extreme caution with any type of price control proposals, especially since the first iteration was so clearly harmful. Chairman Powell, knowing of the hardship caused by this policy on low-income consumers, does it give you any pause to continue down this road?
As you know, this rule is out for comment. We extended the comment period to May 12, so we don't have all the comments yet. We'll evaluate them carefully and make an assessment. I mean, the law does assign us a specific job, which is to assess whether an interchange fee received by a large debit issuer for processing a debit card transaction is reasonable and proportional to issuer costs. This is the obligation that Congress has bestowed upon us, not something we thought we sought. but that's our obligation under the law, and we don't know what else to do than to keep doing it for as long as that's our assignment. That's all we think we're doing, but I think that the concerns that have been raised will be things that we.
Well, hopefully you'll study this and understand that from the previous types of rules along this line, they were very detrimental to a lot of low-income, middle-income folks. As you know, the price reductions that were promised during the Durbin Amendment, for instance, the added profits actually went to the largest retailers rather than go to the consumers as they were talked about. 98% was one of the studies that showed that the retailers kept all the money instead of lowering prices as they were telling us that were going to happen. So I'm very concerned about that. So what's the legal basis for updating your regulation? You've talked about it a little bit. You believe that there is something in the law that says that you need to be doing this updating all the time, or should you be studying it before you actually propose a rule and make all these things more appropriate?
Well, again, I think our reading of the law is that it's not something you do once and leave it there. It's supposed to be reasonable and proportionable to a certain identified issue or costs. The implication being there, if those costs change, then this should change. So that's our reading. I think we do a lot of work. We waited a long time to change it. It's been many years since we did change it, but we do quite a bit of work to make this assessment, and we'll review the comments and the data that we get.
One of the things I hope that you consider is the fact that even though it's supposed to be on $10 billion and up, this stuff all rolls downhill, and as the last study showed, the smaller banks, the community banks, are also feeling effects of this. So be sure and consider that when you start talking and thinking about this. I appreciate that. One of the things yesterday I had two different foreign banker CEOs in my office, and one of them brought up the subject to me, which is very concerning with regards to artificial intelligence being able to impact financial institutions in this country and our banking system. And I tell people, I said, think about this for a second. You find some individual who is a well-known individual, perhaps Larry Kudlow, Dave Ramsey, Bloomberg, somebody who has got credibility, and suddenly you see an artificially produced advertisement or Facebook post, and this person says, look here, we've got 100 banks that have got a problem today. Now, that individual didn't do this. It's artificially produced. I've seen a commercial already with individual. You couldn't tell the difference between that individual and the real thing. We have just come through the Silicon Valley situation. And if you have real-time payments, FedNow, where you can instantaneously transfer money, and you have people scared to death by some well-known individual through an artificial intelligence situation, and I can tell you that China is watching this like a hawk. They are ready to pounce on this situation. I've got some bills that actually would solve the problem. Do you think there's...
All right, everyone. So I had to shut that down because it's just so political, and there's literally no questions regarding monetary policy. I really, really sympathize with Jerome Powell sitting there because this was hard to watch. I mean, in the last, an hour and a half and 90 minutes, this is all the notes I have on monetary policy. I don't know if you can see it, but this is quite literally everything I have. This is not even full page. This is like half a page of notes on monetary policy. That's because that's all political. This has literally been all political debate here. Even though it's supposed to be on monetary policy, it's the Financial Services Committee focusing on monetary policy, and they are it's quite insane that they're just focusing on politics. So I had to shut that down. Everyone can watch it on their own time. I don't want to waste everybody's time here, but I'm going to quickly break down some stocks. If there's any companies you want me to go over, happy to break that down for you from a fundamental and a technical analysis perspective. So let me know if there's any companies in the chat that you want me to go over. We can quickly spend some time. I've got a couple more videos coming out, later today. But is Powell a computer programmer? I know, right? Artificial intelligence and all that. That should be a question for Mark Zuckerberg and, how they're going to sort of stop those types of videos on their platform in the first place. But it is what it is. So anyway, from all monetary policy discussion, Jerome Powell basically said that, when we reach that greater confidence with respect to inflation, that's when they will start to begin to dial back on interest rates. They have some good progress. They have made some good progress on inflation front, but they just need to see some more of the existing good data. And housing services inflation is one of the metrics that they look at when it comes to core inflation, and it's been coming down. And most of the FOMC members' expectations are that housing services inflation is going to continue to trend lower. And U.S. growth, of course, has been a little bit over 3% last year. And Powell does believe that it can see continued growth at a solid pace, and there is no short-term risk of the U.S. economy falling into a recession. And then finally, labor market is still very strong, attractive economic conditions, and we want to keep the economy growing. We are on a good path to getting the economy on a soft landing. Only one person, I feel like, asked some decent questions. That was Mr. Greens. Everybody else had a very, very political angle for it, especially Meeks, Mr. Meeks, and they were kind of obviously trying to convey this message that Jerome Powell is accepting to the idea that most of the money is being spent on Ukraine instead of kind of providing grain to the U.S. and kind of normalizing some supply-demand dynamics to bring prices back down for commodities that can control inflation. So everybody had a little bit of a political agenda or narrative or an angle to it. I think Mr. Greens were the only one who basically did ask some decent questions, but it was, I feel really bad for Jerome Powell to kind of sit through this for the next couple hours if it's going to continue to be this way. Anyway, so SMCI pushing up another 5%, a little bit over $1,100 at the moment. So let's just take a quick look on Palantir. Palantir pushing higher very nicely, up a little bit over 9%. And next resistance and target is going to be at closer to $29 per share. Support level is going to stay put at 20s all the way down to in the low 14s for Palantir as well. Missed my message on Discord, but there's a promising company to analyze, Modine, and that is going to be MOD. We can quickly take a look at this company here, and I will add it to the watch list so we can take a look at this company on a regular basis. Hopefully this is going to be so very, very solid uptrend. Seems to be a very nice, consistently growing revenues over the last 3 years, but recently profitable. Margins did drop in 2020 and then back up here, 49% year to date. So we've got a balance sheet that has a little bit of debt. Valuations are quite reasonable. I would say 21 times earnings, 22 times sales, and earnings expectations for us to see pretty solid growth here over the next couple of years. So 323 all the way up to 455. And this stock has just been on a tear, it seems like, since 2022, up over 1,100%. So very nice, consistent uptrend, I would say. Nice higher highs and higher lows. So this right here is the higher highs and, of course, the higher lows. But of course, a bit more overbought here considering how much it's already rallied. So I've put this on the watch list vault. I will continue to analyze it and share my details, share my analysis on the Discord here. Well, like I said, right now, valuation's quite reasonable. Balance sheet's something to keep in mind because they do have a little bit more debt than cash on the balance sheet. And of course, very technically overbought at the moment as well. Advanced Micro Devices for Kevin here. So AMD pushing higher, breaking out to new all-time highs from this symmetrical triangle. So again, it's going to be a little bit in this price discovery moment right now because we don't really know where that next resistance is going to be. But of course, very overbought at the moment. Support level is going to stay put down to 164, 165 for AMD moving forward. So that's going to be it for today, everyone. Thank you so much for joining in. We'll try again tomorrow. We'll see what the debate is or the discussion or the testimony is going to be like tomorrow. Hopefully, it's not going to be this politically charged and more focused on monetary policy and interest rates and inflation and recession expectations, economic growth. I think that's more important for the markets than as opposed to, having this political discussion. And again, I do sympathize with Jerome Powell. He has to sit through this over the next couple hours. So I'll share the link for the testimony for anybody who wants to watch. I'll share it in the Discord channel. But again, make sure that you drop a like, subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. Patreon link is actually going to be pinned if you're interested in joining us. And there is a 16% annual